Okay, I'm making the last in this series of videos about valuation, and I have to say one more time that if you think this will help you value a stock, it's probably going to do the opposite. It's going to make you get obsessed with little things and never make a decision, and then you'll go against the market and whatever. I'm not going to be like those people who said that uh, Amazon was a crapola investment. Okay, but I want to give you some ideas. Now, the biggest idea I want to give you is some people, a lot of you have to make valuations of various things, of corporations that last forever. They don't last forever, but that's what you assume when you use a constant growth rate and this famous stupid name Gordon's model. If you try to read Gordon's book, it was just a piece of crap. Sorry about that. The valuation, I'm going to talk about just some some basics here. Okay, all right. Here's our diagram. Kind of if you value some explicit cash flows, the big cash flow is from this assumption that the corporation never ends. So you sell the company, basically. You take all these ones, you move it back using the weighted average cost of capital, because these cash flows include both equity and debt cash flows. They cover both the debt and the equity. You get this enterprise value, which covers both the debt and the equity. You subtract out the debt and get the equity. You could do all of these with, you could value equity, add the debt and get enterprise value, when here the value of equity cash flows would be essentially dividends. They're cash flows, okay? Or cash dividends and then selling a stock if you want to talk about the terminal value. If you have no debt at all, the value of equity and the value of the free cash flow would be the same. That's kind of the definition. Well, I should say no debt. Should be very careful. No debt or other kind of fair valuation of derivatives or non-operating assets and all the other stuff that's not in EBITDA. So be careful. And of course, now, there's in our models, we have some history, and then we're going to put a little flag for an explicit forecast period. And then our big one is the terminal value. This is one of the most irritating graphs I've ever seen. I've moaned about it before. ROIC fades toward the cost of capital. They don't say exactly. And they say in the long run, the ROIC is equal to the cost of capital. What? Oh, it really makes me ill, because if that happens, the company should not be in business. You should just close down. The real growth is equal to zero. That means, I guess, all the growth in the whole economy, you just grow by inflation. All the growth comes from other stocks. This company won't contribute to other stocks. So if we're talking about Amazon, they'll stop earning a rate of return on cost. I can't. And they're going to go down and just grow at the overall rate. Maybe that could become so gigantic. Maybe that's not so crazy. Okay, whatever. They're philosophical issues more than anything else. How long this transition period? Maybe I changed my mind just now in this graph. Okay, okay. Here's the thing I really complain about. If you're looking at evaluation, I'm sorry I'm picking on these people. You can get this kind of stuff on the internet. And this was, I might have even talked about it already, but this was the return on invested capital for this. It was, I've taken this airline. It's Air Arabia, I think. And it's just laughable. Blop, 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 blop. Here's the terminal period. Suddenly everything's looking good, which means the cash flow is really high. You can do this with ROE. For me, if you don't put a graph of your ROE and ROIC in your forecast, and you cannot explain really in detail why these returns are going up and why they're uh, uh, earning a lot more than their cost of capital forever and ever and ever. Oof, whatever. Okay, and we're going to talk about this famous growth rate formula that people use. But the biggest problem here is it's so highly dependent on the weighted average cost of capital. You're going to use WACC twice. You're going to take this terminal value and discount it, just like we always do. You're going to discount that at the WACC, fine. So WACC's going to drive it. But this continual value itself is driven by the cost of capital. Oops, here. Now, I used to moan about this. Now I'm going to, don't worry, I'm going to get into the Excel and talk about issues in Excel a lot. I kind of clipped out a football field diagram where it said that DCF value was only this. What a lot of crap. When the DCF, when you look at the DCF, I'm going to have to make this bigger. This one down here with the perpetual growth method. Here, this one starts at 54. This one starts at 65. This one has a range in the, this is if we use a terminal growth rate, which we'll, of course, will get into. We just changed the growth rate from 2.5 to 3.1. What an arrogant thing to say. That's the only limit the growth rate can be forever and ever. And then we change the WACC and just change it by a tiny little bit, 5.7 to 6.3. This is an old thing that when I used to testify on cost of capital, I found it. And then this was the low range, 65, the high range, 65, high growth, low WACC, low growth, high WACC. Now and then, I used to get crazy about this and say, what bull, what good is this when you have such a gigantic range in value? Well, you can think about it a little bit differently. You can think, okay, let's look at a different one here. This is another one. Oh, this crazy thing where the capital asset pricing model is used to compute the WACC, a risk premium of 13%. Sorry, I shouldn't laugh. In different countries, maybe you get even Bloomberg to say that. You should laugh. I'm sorry, this is a joke. If you could earn 13% above the cost of bonds, you get very rich. You don't quite get as rich as Jeff Bezos, but you get pretty rich really, really fast if everybody can earn that kind of return. There's no evidence of that being earned. I can't find any. Maybe you can. These silly things. And you can look at Damaradan with his long explanations. Oh my gosh. Now, here's another one. Of course, the same thing for 1.4 to 4. The actual value, I think, was lower than this. This is the same Air Arabia, I think. Now, you can look at it a little different. You can start, I want to earn a return of 7%. That's what I want to earn. Don't think of it as some formula. I just need to earn a return of 7%. And if I want to earn a return of 7% or 8%, I want to, whatever, maybe I want to return at 8%. Then, if the growth rate is 1%, I'll be willing to pay this and this. If you kind of think about it as a return, and I, when you understand that the corporate value is kind of for a long time, forever and ever and ever. WACC is just think of the return on debt and equity for now. Is that okay? And remember our stock price file, if you watched the first video and didn't turn it off in 1 minute, which you might turn this one off by now. If you have a very, very small difference in returns, in returns over very long periods, it is a really, really big deal. And then finally, when you do the WACC, you can talk about all these, oh God, I have to talk about these, I think, for these country adjustments and these kind of bureaucratic adjustments you make. And I get crazy. Step back and think about what you're really doing. Let's think about the philosophy. When I remember I bought I shouldn't eat that much. I bought a piece of a chocolate in Nigeria when I was there. It was very nice. I went to a shop. A little afraid to go out. I went bought a piece of chocolate. Then I forgot where I went. I went to London, bought a piece of chocolate. And of course the Nestle. There's a company called Nestle Nigeria, and there's Nestle whatever in Switzerland, of course. Is the risk of people buying chocolate that much different in Nigeria or people buying beer than in London. People are going to need beer to get over their horrible problems in life, either one. But instead, you see this is a buy and sell. Luckily, somebody gave me both sides, and it's reversed. You'd think this is the sell side. They want a high value. I think this is the buy side. I think it was reversed. It's such crap. And then one investment made a bank, the big one, they made a size premium, and look at this. The equity market premium is enormous, 6.5. Did they have a equity market risk premium? Well, they had, I don't know. The equity cost of capital was 6.9 here. It was 10.8 here. And the cost of debt was reasonably similar. And then you got this different, you unlevered, relevered the beta and all that. And here's another thing that shows when you change from that same thing, when you change the WACC and the terminal growth, of course, we got these gigantic differences. So I'm not doing much. Please don't rely on this stuff. Think about it, please. And I'm just a low WACC person, I guess. I just think that minimum return, that's what the definition. You ask people to define cost of capital really simply, and it's hard. It's hard. So I'm going to start with enterprise value. Now, I'm going to, now let's get into a little bit of Excel. And I think I introduced this. And this whole model, it's not a fancy model. It took me just a little while to build. But when we look at this, first of all, you can, I think you should put a little uh, a spinner box for some of these things that drive the value. Okay. And then when you want to change everything, you can reset the whole thing. So let's reset it to the base case. And that's going to put our values back. And of course, I'm not saying that I know anything about this. I don't have insights of what's going to happen to Amazon. I'm not a fortune teller. I'm not going to go to a fortune teller. Here's the current market price. If I have these kind of assumptions with this kind of growth rate, oops, I need to, let's put my base case back in here, and my cost of goods sold, I'm just going to have flat. And when I do all of this, kind of the return is pretty good. It stays at 20. That's a gigantic return. And that's a gigantic sales growth. And when I do all of this, you can kind of see, okay, if I use this growth rate formula, and it depends on what my terminal growth rate is, maybe I should put a little bit higher than inflation. You can see, oh, okay, you can get kind of this value, and this would, if you paid this amount and you got these assumptions and you use this valuation method, it would give you about the right valuation. If you use these two, which I'm going to discuss a whole lot more, this gigantic difference between this, and I'm going to talk about why this difference is so big, and this is going to be a big theme of this video, if I can get through it, is go through some of these formulas. But the first thing is look at your forecast and look at the return and the growth rate and the cost. Whatever you can do, you can do whatever you'd like. I mean, to pick some graphs that make a difference. And I used to be obsessed with putting those little spinner boxes in and wasting your time with all that. I think it might be nicer to do something like this, okay? And these things are, we did the scenarios a little bit last time. Oh God, I better get rid of those grid lines, because one guy said, oh, come on, you better get rid of the grid lines. And we're going to look at this, sorry, so we take these different cases, and I've talked about it way too much, but I'm getting obsessed with putting in a macro on these little the drop down boxes, and make sure that you can then fix this. In this case, we just copied the index thing, and then we, depending on if it was the fourth column, fifth, sixth, we put these little things in so we can adjust the spinner buttons. Did I do that too quickly? So this was 525. Then I can put a spinner box to adjust this and this and this and this. I've made too. I've been talking about this too much lately, probably. Okay. Okay. So that's our model, and what we're going to do is go through some of the issues in the valuation model. We start, of course, with our uh, uh, financial model, and I was very lazy here, really. We went through revenues. We first did a little, I'm sorry to review this. We first went through revenues, then operating costs, then CapEx, and then working capital, and then other assets. And then I just wanted to talk for a minute about um, free cash flow. And the way I think about free cash flow, now somebody asked very interesting question about deferred revenue, and I started thinking about deferred revenue, and well, for me that's a little bit like accounts payable. It's we have to be so careful to understand what should be included in free cash flow and what should be included in liabilities and the net debt adjustment. And people get into these bizarre arguments. And I'm absolutely convinced that you can make little proofs of things like provisions. Or I remember I can't remember which country it is, when you pay employees, you have to make a reserve for in case you fire them or they're going to quit or something like this. You have to hold back 10% of your salary, and you call that a operating expense, but you don't pay them until you quit. Well, that operating expense is in a way you put the liability on your balance sheet, I think, I can't remember exactly, or this deferred revenue on your balance sheet, and then you can prove what's going on, and that's just like an account payable. You can prove that that should not be a real liability. You didn't pay any cash out for that liability. That kind of liability where you're going to get somebody else, in this case the employees maybe or something, you're going to get them to pay for your operations. That should be an adjustment. Things like warranty provisions and changes in deferred taxes I find very, very tricky. I should really almost, oh God, nobody, I hope nobody would view it, but I would. No, I wouldn't view my own video. God, I hate that. But uh, 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 when a deferred tax is from a net operating loss carry forward and it doesn't last forever, you better be very, very careful about whether you leave that in or how to adjust it. And if you have for example, a net asset that comes from the fact that you have a carry forward, that's a very different kind of deferred tax a, than a deferred tax that's generated just from ongoing capital expenditures that just keeps going forward, blah, 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 forward, forward, forward. So those are some issues in the DCF. The other issue is I remember I wasted so much time with this stupid half-year adjustment where you can, you better make it all flexible. And when let's just look at the Excel for a minute. Okay, and when you go through your valuation and transfer all this stuff over, now, again, I should have started with one thing. When you think about EBITDA, think about that as your salary, or think about that as your happiness. To become happy, you have to make some kind of investment. Maybe not always, I don't know. I should think about other aspects of life other than financial aspects of life. Maybe, I don't know if you think about children, oh, what a gigantic expenditure, but maybe when you're really old, it'll pay off. Who knows? The IRR is probably really, really low on that one. Think about working capital as just an adjustment to get the EBITDA to be equal to cash, or think about it as a little investment as well. If you're investing in stocks or inventories, those are real kind of investments, and they got to pay off later. Now, if you have suddenly you have a change in EBITDA, or if you want more and more and more higher EBITDA, you're going to have to make higher inventories. You're going to have to make higher capex to pretend that when you have a valuation, that you can make a terminal value without having an adjustment in that terminal year is just a disaster. Now, I brought over the depreciation and all that, so this is actually what I wanted to do. You go to the free cash flow. Now, instead of wasting too much time with all of this, and then I put NOPAT, which was just EBITDA times 1 minus the tax rate, and we get that in our valuation page too. And then we get our PV, our NPV. And I just take the NPV. Remember, that assumes that all cash flows occur at the end of the year. That's what it does in Excel. That means when Amazon makes its sales, you don't buy one single thing until you get to December 31st, and you make absolutely all your purchases right then. Of course, that's not right. Well, we shouldn't make the assumption that it happens at the beginning of the year either, should we? And when we do this, we always should, when we have an annual model, just make sure it happens in the middle. And all you do is multiply that by 1 plus the whack raised to the half power to make sure it comes in the middle. So instead of at the end, you get it in the middle, it increases your value by a little bit. All right, whatever, not a big deal. And then I'm going to make some stable period adjustments. This is this idea, this obsessive thing I have, that if you use your and I'm going to come back to these, but if you use your WACC growth rate formula, if you have a higher growth rate here, you better have a higher capex to support that growth rate, and you better be paying more for inventories and stocks and accounts receivable and all that to support that growth rate. And if it's lower, you can lower those things. So you need that. So you need to make these sort of stable period adjustments. And then when we compute, so this, what I do here, I should say this again, this just uses our true false flags. This should be all kind of standard, I hope. The Excel, we put a different terminal period in, and I hope I have the calculation option. I don't have that on manual. And why is that spinner button not working? I'm not going to worry about that right now. That was a little embarrassing. Explicit year. Okay, it's working here. We better be able to change all that. I better, oops, I'm just going to move that over here. I have no idea what mistake I made, but I'm just going to fix it. Okay. All right, and then where did it go just now? Okay, I'm not looking at it here. And this one should be also a little bit different. I guess I better save this file, and I better find what that one I just did. Okay, and then so this I could apply a stabilized terminal value, a normalized or stabilized terminal value. Okay, as well. So that's a little bit just about getting the NPV right and so forth. Again, remember what I'm trying to do is practice. Practice for an online class. And if you come to online class, I hope it's going to be completely different than a video. You're going to stop me. You're going to interrupt me like crazy. You're going to say you don't believe me. You're going to ask me to go back to a formula and explain it. And I'm going to have you share your screen, not me. And we're going to make it as interactive and as worthwhile. And if you have some questions at the end of the session, I'll go on and on until we resolve kind of things. Um, and I'm going to ask you to email all the questions ahead of time. So that's enough of that. Now, let's talk about some terminal value and how we normalize the cash flow and which terminal value we should use. And in particular, I'm really going to go through uh, uh, the can I get a word out in the value driver formula? Okay, and here's some philosophical aspects. I just used that file, that stock price file, and this is before I figured out how to get rid of the NAs. What's the consumer price inflation? If we just use an inflation in the growth rate, what happens? And I did that for other things. And what's the world population? Is in real terms is our, I don't know, if we're selling food, if you assume that the industry can grow faster than the population, so you can add some inflation. We're doing everything in nominal terms. People are going to get pretty fat. Maybe I'm kidding. And if you're selling beer, and you assume that the growth rate all the beer companies is a lot higher than the growth rate for the population, people are going to get pretty drunk. So you better be careful with those long-term adjustments, those growth kind of adjustments. And I don't know. I tried to compare the GDP and consumption and all that. We could go back to that. I've already belabored that one. Okay. Now let's go through some alternative methods. I'm going to talk about 5, not 4. I'm going to talk about this growth rate method. That's the traditional one that's used. You have to make some adjustments. You don't have to, but you should. This business I just talked about, if we use EV to EBITDA multiples or PE multiples, why did I have a little space here? We should think about that. Then I'm going to talk about the value driver method and the subtleties and the errors and the disasters you can have with that value driver method. But my recommendation will be a complicated, bizarre thing at the end. Okay. And in order to do that, I worked with my friend. Okay. Now, for so many years, I have been trying to come up with a way to present and explain what drives the PE ratio. Now, this could be the value to income ratio. We could call that it's EV to EBITDA with some adjustments. Same with the price to book ratio. What drives this? And also, what drives the difference in growth rates? In terminal values. Now, in our Amazon case, I'm going to have to come back, and I will not fully kind of explain this. I presented different terminal values. Remember, I have no idea. I am not claiming that I know anything about Amazon. Right now, I made the cost of goods sold percent go down, and look at this ROI. For me, that's a little dangerous, so I'm going to put this ROI back to the constant case. I have to. And then it's still a pretty high return. Can they sustain that and this growth without having everybody try to copy them and be efficient and get better programmers and everything else and go around the world? Who knows? I don't want to comment on that. And what kind of return do we really accept? If I'll put a little bit of lower return here, I get these different terminal values. I get, because in our valuation, I just applied some very standard kind of values. I made some stable period adjustments for working capital and for capital expenditures, but I'm not going to kind of do too much now. I tried a terminal value with a growth rate method. And when we use that terminal value with a growth rate method, all I did was apply the 1 plus G divided by K minus G, or WAC minus G, whatever. Okay, and then I used just a flat multiple. Of course, that has a whole host of other issues, and to cover this in one single video is going to be a little bit painful, but that's exactly what I'm trying to do by explaining what's in the PE ratio. And then I take this 1 minus G over R over ROIC divided by WAC minus G. I get a multiple. and I multiply the NOPAT in the terminal period. So up here I got the NOPAT just from our little switches, okay, and I multiply that by the value driver, and I sound all really smart by getting a different terminal value. So I got 1, 2, 3. And then I say, no, 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 no. This one is a black box. Let's take that same thing, but instead of simply multiplying it by the existing income up here, this was by the NOPAT. Let's take the invested capital, multiply that by our new return on invested capital that we're assuming here, and then multiply it by the multiple whatever, and blah 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 blah. I'm going to go through it again, but I get a very different terminal value. Now here's what I've been trying to do for so many years. I remember it was in Denmark. I remember these silly things, and one man said, "Look, what I want to do," and it was brilliant. He was smart, and he was an investment banker, so he was dressed in a nice suit and everything. And he said, "I want to be able to explain to a client why the price to earnings ratio is different. What makes this price to earnings or EV to EBITDA different than the PE, which is another subject. I can't get into all that. For now, could you please, I beg you, and this is beg you, just assume a company has all equity capital, no debt. So the return on investment is the same as the return on equity. Okay. Now, if we're going to look at a PE ratio and a price to book ratio and these multiples, what I did is I made this little control sheet. Now, I've also made a little data table that I kind of just messed around with and used a different method. I'll show you it. Oh, good. So what? So we have some constant returns that last the same forever and ever and ever and ever. Well, only for 513 years. Why made it 513 instead of 515 or 300? It doesn't matter, of course. And then I have some flat growth cases. And then I suddenly change things in the terminal value. One sudden dramatic change. And then I say, no, 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 let's not only change it in the terminal value, let's, I said BS comparables there, just a minute. This issue, I'll cover this right now. This issue that you can find some comparables, what a fraud. One of the frauds of doing all this analysis. This graph that I used to hate and moan about and go crazy about, where this is the explicit period, and in the terminal period, we don't just change exactly in one period. We have a gradual change from a company that's earning a good return down to something that where the return equals the cost of capital. That's why you get differences. What happens in this period? How long is this period? Instead of making some black box and all of that, we're going to try to actually address it. Whether maybe it's better to assume it all suddenly changes. The growth suddenly drops and the ROE suddenly drops instead of gradually going down. Maybe that's better. Okay, and maybe I think what's happening here, and I'm going a little crazy for many reasons. But one of the reasons I try to make this model so you can see what's really happening, and I'm struggling. So what I did is make a bunch of scenarios. And I made these so you can make longer periods or short. This is our explicit period, and then this is that little period up here. This is this period from this period. So we got this period, this period, this. I cannot believe I'm using this graph that I've moaned about for so many years now. Okay, whatever. And so if we do this, we have and then we have some intermediate growth. We have the growth right before the terminal period. I don't know why I really did that. the growth in right at the terminal period. I don't know why I said initial terminal period. Okay, I'm changing this. And then we have this post-terminal period. Well, maybe I'll leave it initial. Okay, because I guess that's the point. There's no single kind of terminal period. And then what this last method does, it says value, should say value driver. And this should be value driver incremental. So I had to change the Excel file in the middle of this video, and I keep on changing it, and I want a file so badly, so very badly. This is the one I started on with my friend Patrick, who's the professor at La Défense in Paris. We started it by just making constant returns and so on and so forth. Here's what I'm going to do to try to explain this. Well, let me just introduce it. I'm not sure I put this in my earlier thing. I hope I didn't. But there was a man in Denmark, a brilliant man, who really, and there was another man, I just can remember. They were true believers in this, but I'm going to call this black box method, where you take the income, multiply it by 1 minus G over ROIC. They had all these reasons for doing it, and they said, well, we're going to, in the long run, the return equals the cost of capital and all this stuff. And there was another man sitting next to him said, look, I want to be able to explain. I don't want to show any formulas, but I want to explain to a client what this PE myth means and what this price to book means, or the EV to EBITDA ratio. In fact, I almost should put price to income here, or value to income and value to book. I'm going to leave this for now. Okay. And so I'm going to introduce this video. Now the second thing I want to do so badly is when we go to this Amazon case, I want to explain to somebody, why is this terminal growth method where we just assume a constant growth rate from the prior year's cash flow? We might have to apply some stabilizing things. That makes a big difference, where we assume that there's a capex to support our new growth, and where we assume that the working capital gets adjusted. Or we could apply an EV to EBITDA ratio, but in order to do that, we better understand what makes an EV to EBITDA ratio big or small. And I'm going to tell you how bullshit that is. Sorry about swearing, but this is so exciting, I'm going to have to swear. And then I have two different value driver methods, and they're really bad because I assumed that the rate of return over the long run is pretty low. Now, if I put a higher rate of return, we still get a big difference between these two. Not as big as I thought, but some difference between these two methods. We'll talk about why. Okay. And I guess if I change the WACC maybe or something, maybe we'll get a bigger difference. All right. That's what I want to discuss. I'm going to try to explain to somebody why these methods produce different results, and importantly, why sometimes you should use one of these methods, neither one of these actually, a fourth method, and what's wrong with some of these methods, and what's wrong with this that seems to be the most traditional method of all still, without even making adjustments to that terminal value. Without people saying, it's pretty obvious that if you have to increase, if you have a lower growth, you need lower capex and lower inventory investments and all that. And they don't even make those these kind of stable period adjustments. And we're going to talk about that here. And now I'm going to go through the results and then show you how I got them. Now, if we just have a constant, this red line is the cost of capital, and the blue line is the rate of return, and everything's flat. If everything's flat, we can just use this formula to figure this out, or we can use a constant growth rate, or we can compute a theoretical value. Now, this theoretical value is the value over 500 years. I'm going to show you 513 for some stupid reason. I used that. This is the method where we take the last year's cash flow, whatever it is, multiply it by 1 plus g divided by k minus g, or we can make some stable period adjustments. Now, if I have everything flat, doesn't matter. This is this method where we take the income times 1 minus g divided by ROI, ROE, ROIC divided by k, WACC minus g. Could use it either from equity or cash flow. Oof, I'm excited about this. That's why I'm going this. And then I made a sudden value driver method. This is where we say, okay, don't take the income, recalculate the income as the invested capital or the equity capital times the return. That's what income is. But this income is the old income that might be higher. This income is a brand new created income, and then we multiply it by the same thing. And then this method says, no. Let's gradually have the return go down, which is what this thing is supposed to do. But the reason I call it a black box, we don't know how long it's going to take. And now this is about the third time I've made this video, and this time it's kind of getting me mad, but in a way it's not getting me mad, because finally I hope I'm going to be able to explain these things that I've been so lacking in to be able to explain for so many years. You kind of know the answer, but you can't explain it. So I'm going to try to take a simple example and explain it. Now, what I do then is I start making new scenarios. I put a higher growth rate, a higher return with the same growth rate. So I just increase the return. And when we increase the return, notice that this number changes too. We can change it from either these things or these things. When we increase the return, it goes from 190, let's say 190 to 240. That's pretty good. So that shows you that a higher return is really important. And they all give the same answer, because when we have this constant growth rate, we're going 6 years and we're cutting it off, and then it's just growing at the same rate. They all give you the same answer. If everything happens, if nothing changes, these things don't matter. And then let's put a constant return. Let's put the return back to 10%, but put the growth up to 6. Then we get 375. This was 243. In this case, the growth seemed to matter. But if I put a much higher cost of capital and I make our cost of capital closer to the return on capital, then we'll start the whole process again. Then we start with 134, higher return gets us 173, higher growth gets us 167. It didn't matter. But so it's all these stuff put together. Now, I've made a lot of other videos and analysis that show you can't just say growth, you can't just say return. What you want is both. And if you have a high growth rate and a negative return on capital below your cost of capital, we should all know that. So let's make a higher cost of capital than even our 10%. I hope it goes up there. And was our 10%, was that our base case? Come on, hurry up. This little 500-year thing seems to slow things down. So now if I put my constant growth rate, here's what I get. Here's my value. It's pretty low. Higher return, that gives me a higher value. Higher growth, but the same return should give us a lower value. And it does, because we started with this value at the same. So you have to have both. You can't just say growth is better or return is better. Like, we'll show you a slide from McKinsey in just a little while where they say this. In fact, I've got to go through this. I've got to show you this. This is a quote from their book, and it just makes me throw up. I told you, I read this McKinsey book 3 times. I bought it a lot. I paid for it. I did not steal it. No way. And I don't care if you steal my book, but they've sold about 4 million copies, which is about 3.999 more than me. And here's what here's some of the statements they said. Now, when we go through this, I guess I'll skip. By the way, I say anybody who claims they can find comparables is such a what bullshit. We've all tried it, and we know it doesn't work, but we pretend it does. So I go through this value driver formula, and to get it, you just can start with Gordon, Mr. Gordon, who wrote a book, like it's a little tiny 200-page book. I read it when he was trying to justify higher utility rates and testifying on cost of capital like I used to do. And he said the value of a company is D1 divided by K minus G. I don't know if he did integral calculus to prove that, but you could. I have to remember how to do it. It's kind of pissing me off that I can't remember how to do it. And then in the 70s, I remember learning this formula. This formula says that it starts with growth rate equals 1 minus the retention rate, which the retention rate times the ROE. The retention rate is 1 minus the dividend payout ratio. You redo this. This is the only meaningful way to do this formula. And then you know that dividends equals earnings times the dividend payout ratio. So to get the value, just substitute. In this one, we stick in D1. So we have value equals E1 times P. Oh, E1 is the next period. I didn't say that. I don't want to waste time with the subscripts and all that. And then you substitute for the DPO this thing, and you get the value formula. You can also say, let's take this value divided by E1. That gives you the PE ratio. That gives you the whatever, the same formula. And you can even go to the price to book ratio, because you know that earnings are book value times ROE. So value equals book value times ROE times that. And then value divided by book value is ROE times 1 minus G, but multiply the ROE, so it's ROE minus G, ROE minus G times ROE, and then you divide it by 1 and all that stuff, and you get that number. And then here's what these idiots say. First of all, they say, technically we should, when we talk about this return, we should be using the incremental return on new assets and differentiate that. Think of Amazon. They have a new truck, and think if their value is going down or up. Do you think the old truck gets a different rate of return than the new truck because they put the new truck in? Well, if their demand goes down and if their margins go down, all the trucks get a low value. What kind of crap is this? And it doesn't work anyway. We'll talk about that. And then they say, okay, we show that high ROIC companies create more value by focusing on growth. Well, okay, if you got a high ROIC, you really want to grow. While low ROIC companies, you just want both. It's obvious you want both. What a ridiculous thing. If you got a low ROIC, get out of business. Don't grow at all. If you got a high ROIC, you better watch it. People are going to come and copy you, by the way. The median U.S. company earned a 19% ROIC. What an enormous profit. While the median large Asian company earned 8%. Ooh. For the most part, Asian companies historically have focused more on growth than profitability, or ROIC, which explains the large difference in valuation. So they're kind of bragging about the U.S. Oh, great U.S. companies, they're earning a really, really high return. They're like Nike. They're not making any investments, or even Apple. They're not making any investments and they're getting a really high rate of return. But you can't say, of course everybody wants a high return. And you can't say that growth and return, you can't make these statements. You got to kind of prove them. And oh God, does that irritate me? But I don't want to sound anti-American or anything. Not that. All right, so let's put our return back now. One way to put the return back is just to click on this one. Excuse me, did that not work? Oh, I didn't put that as part of our little macro thing, which I'm going to explain in a minute. So let's go down to a much more reasonable whack. And 6%, I think, is a really, really high whack, by the way. But I don't want to get you all mad at me for that either. You don't have to believe me on that. This one is not about moaning about how high or low the whack should be. It's more about explaining what the WACC is and going forward. So that's so far we've got the same. Now after that one, we go to another case, and I'm going to explain. So what my method here is something Winston Churchill, but everybody else says too. Show it once, show it what you're going to say it, and then recap it. I'm not going to bother recapping it, but I'm introducing it and then going forward. By the way, when I do these cases, this is the flat constant case, and then when I do the next one, you see that the price to earnings and market to book, price to book ratio, you see how those kind of change. So you can, the first idea is to explain people where these multiples really come from. That was the first time I started to do this before really investigating this. Now we start to have an interesting one. So now now I put a lower terminal growth rate in here. No, lower terminal return. So we keep the growth rate the same, but we say over the long term, we can't keep earning this high rate of return. That would be an issue in the Amazon case. And in this case, when we just take that last year and just keep growing it at the terminal value, we don't reflect what's happening to the return in there, and the growth rate gives us a much higher value than the true value. Okay, now we can try to make a stable period adjustment here, and it doesn't affect, oh, it does a little bit. You see how that growth rate method comes down. And I'm going to explain that in the context of the next thing. And then we have this black box method, I call, which doesn't push the return down immediately. It gradually goes down because you apply this against the current level of income, and somehow it's supposed to go down. And if here's for me the interesting part, I don't know, we can try it with this one. If I, no, I can't do it with this one yet. I can't do it with this one yet. Because I'm trying to prove how long it would take to go down. I'm going to do that with another case. Now, if I put a lower terminal growth rate, so we keep the rate of return exactly the same, and we put a lower terminal growth rate, at first blush, this seems to give a lower value than the true value. This is the true value. Remember, this is the true value, and actually, this is a little bit different than these right now because of, I don't want to go and redo these. I think there might be 1 plus growth rate issue here. But if I put if I put a stable period adjustment, then they give exactly the same thing. And that stable period adjustment says if we're going to make some capital expenditures, we've got to adjust those capital expenditures in this terminal period. So if we grow less, we've got to reflect the fact we're going to get a higher dividend when we suddenly grow. That's a big deal. Okay. Now, and notice it changed everything. Now we're back to the same. If we make that I'm repeating myself about this stable period adjustments that or normalizing adjustments. Now let's go to the next one. Let's put a lower terminal growth and a lower return. We'll leave the stable adjustments in, and we get this, again, the same thing where this black box method gives us a much higher number. The growth rate method gives us a higher number for the same sorts of reasons. Now I'm going to change something. Now it's going to get a little more interesting because now instead of just all of a sudden going down, we gradually go down. Okay, and this is, again, I moaned about a graph here, and I've got to take everything back. I really have to take everything back when I moaned about this chart. I'm looking at that chart. and then I kind of retracted a little bit. But this one, we have three periods. We have our explicit period, we have our future period where everything's stable, and then we have an intermediate period. Now, I added this medium term, uh, uh, and they had assessment of industry outlook. I've never read this. This fade period. I should call it a fade period. Oh, crap. That's the word I was looking for. So instead of this fade period, uh, and we can what I did is made it so this fade period could be shorter, okay, or it could be longer. Now if I now let's look at this approach versus the true value. And we can now finally, this is what I've been wanting to do for so many, I've tried this so many different ways. Now I'm making the fade period really, really long. The only problem, I was afraid to do that. The graph kind of looks funny, and I don't know what happened to this cost of capital thing in the graph. And if now this isn't long enough, but if I make this fade period, I'm trying to de-black box the box. And if I make this fade period really, really long, can you see what's happening? Then the theoretical value is going up. And I can say that this black box method, for this black box method, and you can, if you don't believe me, I know I've got some negative comments, which really, I don't give a shit if I get any comments. I'm kind of happy. Uh, uh, it's like it takes 100 years almost. It takes 100 years to get back. Now, what I really should have done is on this control page, I'm sorry, on the scenario page, I should have reset it. So what I'm going to have to do is reset this to 5. Okay, so this for me is just a gigantic deal. I know nobody kind of cares about it, but it puts so much stuff together. Finally, this method, which is this McKinsey method, I want to de-black boxify this. I want to figure out what's really driving this one. This method, you notice, gives me the same thing. Now, this is kind of a cheating method where I say, let's put a fade period in. Let's tell me how long the fade period is, and then I'm going to assume the rate of return gets low during the fade period, and then I'm going to give you the value. Now, if I did the other way, this sudden driver method says, no, no, don't ignore that fade period and just put it down immediately. So you can see that this undervalues the thing. I'm arguing, of course, for this final method. It's more complicated, of course. If it was really, really easy, everybody would be doing it. That's like all these other things. Okay, and then this video is going to be very, very long because I'm going to go through and explain in detail how I did this. I'm repeating myself a little. Now, if I would make our fade period be immediate, okay, and that's really the cool part of this, then these values give the same result. I don't know what that little tiny difference is. It's due to some growth rate thing that I really should work on a little more. But that, for me, it's so exciting to finally be able to answer these things. And we can even look at what the effect of this fade period is on the PE ratio and the market to book, price to book ratio. I keep on calling it market to book because of my days of testifying and objecting to the Gordon simplistic method in cost of capital in utility companies. We used to call it market to book ratio. Okay, and I'm putting some of my old testimony on the website if I can find it, because I used to really get people mad at me. Nobody believed me anyway. So now I can put just a low terminal growth. Instead, I keep the return the same and put a lower fading terminal growth. Now this one doesn't reflect the lower terminal growth. This one's, they overstate it also because there's nothing in there about this fade period, and this one gives the answer. So if the changing
growth, that's okay. This method can handle it. I'm always using a stable period adjustment. If I don't use a stable period adjustment, I get a pretty big error. That's this, again, this idea that in the terminal period you should put a stable capex to depreciation into your analysis. Now, if I use here, then now I'm doing both. And when I do both, who knows, I get a much higher value with the growth. This one produces a high value, not quite as much as this. This produces too low a value. And finally, we get the Goldilocks just right value from our theoretical number. And of course, if I change the fade period, I get a different result. Okay? And now let's keep going. Oh, now I just put it more extreme. And then we get more extreme kind of differences in the valuation. And then I put a different growth rate, which is more extreme. These all produce the same result, but it's too high because the growth rate gradually goes down. We're just using this growth rate instead of the final growth rate. At least that's what I assumed. And then I said, okay, no. Let's, in the explicit period, let's have the return go up. And when I do that, then the PE ratio is really, really high. So some people said in my class, can you get a really high PE ratio? I said, of course you can, because the PE ratio is computed on the basis of this return, and everybody knows it's going to go up. And then I said, well, let's put an extreme increasing return, and then you can get a PE ratio of 100. And that you're earning less than your cost of capital, and then I said coming down and all that stuff. And you can put all of these kind of things in there. Whew. And let's put a decreasing return case. When we put a decreasing return, we get a lower value. Even though we're earning a really high return, we're getting a lower PE ratio. And then I hope I put then I put a decreasing growth rate. Not much interesting there. And then I put an extreme decreasing case. And then we get the lowest value because that's your current earnings and they're going down. That should be kind of obvious. So we can't apply these simplistic ones. And then I tried to say, well, if we have the WACC equal to the growth rate, then of course, if we start changing all the growth, decreasing growth case, increasing growth rate, whatever, they're all the same, flat growth case, and you can change either one of these, and I'll show you how to set up an assumption like that. And then I don't know why I put all these things in, turn equal, zero growth, and then I put zero growth, and you can kind of see what happens if you have zero growth and different returns. Okay? I think that's enough of an introduction to this. And I hope you're saying, God, I should do some of this. Now, what I did is I made a little data table of all these cases where we show all of these. And then I put all of these cases together. Now, when I put all of these cases together, I don't know if you noticed, so this is the fifth case. And that's why I thought I didn't fix the cost of capital and do that really appropriately. What I did is this method that I've been spouting to you a long time, and that's the original reason I was just going to make this whole video, is if we change this scenario code number, okay, to 7, then it gives this index value, of course, goes up to the 7, gives me the 7th number, very standard. And then this is almost becoming standard to me too. If we do an edit here and assign the variable, it says range applied equals range index. And what I should do is then I should make something else. What I should have done is this is in this applied, we have 1, 2, 3, 4, 5, 6 columns. And in the 6th column, so we obtain cells, row 1, it's only got 6. dot value equals the same number times 100. Okay, and if I do that one, okay, now I've got to be a little bit careful here. Now, when I change this case and do the little thing that copies, this will be, just a minute. This was 1, 2, 3, 4, 5, 6. Why did that not work? Cells applied. 1.6, just a horrible minute. I gotta listen to Napoleon about stop, dress me slowly because I'm in a hurry. Oh my God. Okay, so if we change this one, then it puts like a value of 6.8. Now again, up, 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 up. I'm gonna do this over here and make it times 1,000. Okay, and then when I do this, okay, it's going to give me 68, and then I'm going to go through some scenarios. And we had starting book value, and we had the cost of equity capital. This number now, when I'm going to delete this one, and right-click, and this format control should come, and whenever I have these, it should come from this 68. And it's very likely that I've made some mistakes about this. Just a minute. And then, oops, 1,000. And then when I do this one, I'm not so sad that I'm doing this. This number comes from the scenarios, and I can change this a number, and I just screwed up again, because when I change this number, the thing I want to do is change it right here on this famous number here now. And now we have to put it back, so we get our 6.8, which is our starting point, and I can change it here. I hope I can change it here. I can put it up here, okay, and then it changes it here, and it changes it here too, or I can change it here. That's the whole idea of this method, where you can do either one. Now, which brings us to our assumptions. And in our assumptions, I made and I'm going to put this as the fade period. And when I did this fade period, I can put a longer fade period or a shorter fade period. And I made it so I put a terminal period here. Okay, and this is 1 plus the terminal period. So you start your changes right after the terminal period. Okay, this is actually the same. And then this is our constant growth case. This is the other growth case. And why don't I go ahead and put Alt-EIS enter, and just remember how you do this conditional formatting. It's getting easier for me. I guess I'll select this one too. It's not necessary. When you make your little scenarios, it's so easy now once you get the hang of it. You go to conditional formatting, and what that means is I'm going to screw up like I just did. And no, I didn't. Conditional formatting, new rule, use a formula, and in this formula, you want to always use the top left. It's the top left rule, or at least the top rule. And then you keep it on B, but let the 16 change, and make sure this one is associated with this one. And please format it as a nice light color. And I made my generic macros so it won't override your formatting, And so that's it. So now if I change this big master scenario down here, it'll change it. Or I can start with this one and change it here. And if I change it back to the original one, it puts everything back to the base case and changes it here. That's how you can get it all very flexible. Okay, and then this is where these ones have a fade period. So when this is different from this, we have a fade period. And I call this final terminal. I think that's okay. An initial terminal, that's at the start of the fade period, at the end of the fade period. And then I did the same with the growth rates, okay, and put all those different growth rates. And you could change this and put whatever stuff you want in it. And then we go to our valuation model. And in our valuation model, just let me make sure. Okay, in our valuation model, let's just see how it works. So what I do here is at the very bottom, I don't know if this is a little repetitive because I could have just used the index. I put these numbers in, and you notice, let's make the terminal period a little bit longer, and let's make the fade period a little bit longer. So these are not equal numbers. There's an increment. And there's an increment. And what I do to make this wonderful fade period really work is I use the interpolate command, which I'm not going to belabor you again on, but I've been babbling about it for so long. And one of the sad things I have is it's not that sad. It's let's put a return. Let's put a lower final terminal return. Okay, so we start with 12%, and then we go down to 11% right after the terminal period, and it gradually goes down to whatever the 7. And this 11 was kind of the year right after the terminal, and then 7. On the other hand, if we just put a lower terminal return, it just leaves us at 12 and then just drops it down. Same thing with the growth. Okay. And then now I struggled with this. I thought this would be so easy because I've done this so many thousands of times in my classes. I say, oh, let's start with a book value. And then let's make the opening equal to the closing, blah, 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 blah. And then we'll make on the opening balance, whenever you do these little proofs and exercise, you use the opening balance, we'll multiply that by the rate of return. No big deal so far. Okay. And I'm going to put this back to our constant case. Okay. For me, setting up these scenarios is a big deal. And then now I use the dividend payout ratio. If you're going to grow, you can't pay out all your money. Okay, but if you're going to say no, this is net income and this is dividends, I want to use a free cash flow approach, and basically it's really the same thing when you think about it. If you're going to grow, you're going to have to spend a lot of capex. Your income is going to be your NOPAT, and you're going to have to spend a whole lot of capex. And after you spend that capex, you're going to have less cash flow to pay off all your debt and equity providers. Okay, so it's really the same thing. Please. Now, so this is the cash flow, and then when we make our theoretical value, it's just this cash flow, and this cash flow goes on and on and on for 500 years. And I even made a little adjustment in that very last year where I said, okay, let's take that. And why did it? I just had to fix a little thing, which could have explained. In the very, very last year, I put a really, really high terminal value, and that's why this true and false in our initial things had a little bit of an issue, which I was a little bit worried about. That's fixed. That was blah, blah, blah. Now, so our change in investment, by the way, when this is cash outflow, this is money that you've earned your money from this, but you've had to increase the investment. So if we have a higher growth case, high flat growth case, then we have to make more of an investment. Okay, so that's our starting point, and this is the true theoretical value. And you don't argue against me on that. That goes to 500 years. It's just got a flat growth, and it's basically forever. Okay, and now with the the older version of Excel, you couldn't do this, and it's all very fine and flat. And then our price to earnings ratio is simply the next year earnings. This is like a forward PE ratio divided by the value divided by that. And then this one is this. And of course, I should be I'm making control. I'm going to do that right now. I hope I'm not screwing it up by making my little colorization. Okay. All right. And I just have a little bit left to go here. And okay, I put kind of the sum in this column. That's kind of nice, isn't it? And then now if I do our growth case, all I did was said, okay, let's put now instead of a flat growth, let's put a lower terminal growth rate. So our growth rate goes to 2.5. Now think about if you would do this. You don't know. What you would do is you take your last growth rate, your last cash flow, and then to get your value, you'd use this 2.5% growth rate, not the 4% growth rate, and you'd put the 1 plus G divided by K minus G. That's just all our standard valuation. And now if I do a couple of other things, I'm going to switch off this. What happened to my little, there it is. If I don't have a stable return, something funny happens. Something very funny happens. In the next year, right after this, suddenly we get this pop in cash flow growth. And the reason we get this big pop in the cash flow growth is because if we're growing lower, we have to make less capex. And if we just take this last growth rate here and say, okay, we're going to just be able to grow that at 3%, well, what we should be doing is making a stable period and adjusting our capex for this. And I should be looking at this one, not that one. So let me do that again. Right now it's 8. We're just going to go stabilize that and grow it at 3. But what we really should be doing is reflecting that this number is gonna be higher because we have to pay less capex. We have to take less out. And so our little terminal adjustment just is what it does is it says if it's true, then we change this dividend. I use the dividend payout to make this kind of stable period normalizing adjustment that nobody does and everybody should do one way or another. For me, it's a gigantic deal. Now, when we do the next method, again, we're stopping our terminal value. We're putting a terminal value here, okay, and then we're in this case we're starting with income in the terminal period, and then we compute this famous value driver 1 minus G over R ROIC divided by K minus G. I can get it right. I used to get it all wrong. And then we have to multiply that by 1 plus the growth rate, just like we did put this 1 plus the growth rate in here if you get really technical. And finally, I'm getting technical. And then we can take the explicit value, which we did, the value over the explicit period without the terminal value, the same thing here. I just took that. But for our terminal period, that's our sum. For our terminal period, we take the present value of this final cash flow, and then you can start proving things. Okay, so if I now, instead of have a flat constant return, let's put a lower terminal return. Actually, we get 179, and this one still gives us too high a value because um, you're starting with this final NOPAT and you're not adjusting this NOPAT, and we have a really low terminal growth rate. What if we have a higher flat growth rate. Then we get 372, and it gives us the same answer. Oh, I should have been. I was expecting a different one there. I need to explain that, but I'm in the middle of this video and I can't get it. Shit. Okay, and now, no, was I on the wrong one? No, I was on the wrong one. Yeah, no, that's okay. This gives you a high value, and then if you instead take this up here, we have the balance of the invested capital. We have the balance of the invested capital, and instead of just taking this final terminal year, we say all of a sudden we're going to take this amount and we're going to multiply we're going to use the same adjustment, 1 minus g over and then we're going to multiply this by this number, which is the 9%, which is our final, not the current year, but our expected future value, and we're going to push that down. But that's a little extreme because you're going to assume it falls all of a sudden. There's no gradual change. And the final method works through a gradual change. And what I'm going to have to do now is pause the video because I have to watch the television show, okay? And I'm going to finish this one tomorrow.
Now, the last method to discuss is this final method where I combine both of them. I know this is an extremely long video, and frankly, it's kind of bad. This is the this is like the big climax. It's the way you can kind of combine these methods. So I can't imagine anybody watching such a long video. But here goes. I'm gonna finish this up now. Before we do this, I'm gonna remind you something. What I did is I added something. I took a little break and I added just this little thing to remind you that when we use this black box method, we're going to the return on invested capital all the way at the very last, at the very end, not in the middle. And I put this kind of range here on this one. So this is the sudden one, this is the black box one. I'm not really saying that this is somehow in between these two. You notice this is, in this case, closer to this one than that one. Okay, but for me, this is the big deal. And then, of course, where let's put a lower final growth rate too, and then we can make our fade period change. Okay, and what I'm going to do, I need to say this. I need to say this. Perhaps I'll put a little annotation here. Is I'm going to do this with free cash flow, and I'm putting a whole page really on the website about all of this, on my website about it all. Okay. So the question, and you notice this method is very close to this method. It gives me a slightly different number when if I seem to use a flat growth case, then it's all kind of, it gives me just about exactly the same number. Now, I want to, just before I get into this very last case, I want to review this stable growth adjustment. If we just looked at some cases and they were all, it's kind of like these two cases were all the same, even when I had this lower uh, terminal return. Now, if I didn't put a stable growth rate, a stable a period adjustment, this method gives you a different a number. I had a little bit of discussion and I was a little confused. It's driven by this idea of putting a stable adjustment that I'm trying to look for a lower terminal growth case. Okay, then we get some differences, but when I
put the stable period in. At least these two methods kind of give me the same result, and that's because after we stabilize this one, after we fix this one, it's almost like fixing the rate of return. Okay, of course, that doesn't happen when we start changing the return, and this return is going down to a lower number after here. Okay, so that's a little bit of review. Now this is the method that, of course, I purposely made work, and that's because I used this fade period, and after the fade period, everything's the same forever and ever and ever for hundreds of years. Okay, that's our little kind of philosophical idea about this. And here's how I did it. The first thing I did was put just a little bit of a post-exit period. In this case, we just had 4 periods. That's our exit period. So I first put 3 extra flags, masks, switches. Switches is my name for it, not my actual name. Okay, and that's just true forever. That just allows us to kind of keep going. I don't know what to say. It might not even be all that necessary. And then I put a final. I'm going to put this end of fade period, and I should put value driver, and I'm going to call this fade period. I'm just going to make a new name for it now. And I'm going to make this one up here. I'm going to make this one value driver fade period. Isn't that a better name for it? Okay. And then uh, post, I'm going to put fade holding period. And then I have a call every single morning with Korea. And that's what popped up just there. So then the next thing I do, I just, and perhaps I'll come up with a better method sometime else. I used a little bit of a lookup, and I said, let's find the opening balance of the invested capital at the beginning of the fade period. So invested capital fade start. Okay, and then after that, I put sorry, that's life these days. I put a growth index, but this growth index, I'm going to take that out. Excuse me, and I'm going to leave that in the video because I'm so sick of this. So we have the beginning, then we say, okay, well, just multiply this number, and then that gives us, if you look right up here, that gives us the opening balance at the beginning of the fade period. So this is a little bit tedious and horrible. It's not really complicated. And then we say, well, let's take the difference. Now, since this is the opening balance, I actually have to go forward, and that's kind of why I needed that first switch that goes all the way forward. This gives me the increase in the invested capital. That's a cash outflow. That's like your CapEx minus your depreciation. That's the amount you had to reinvest in the company. That's the retention rate, however you want to call this. And again, I'm going to repeat myself that I'm going to explicitly do this with CapEx and EV to EBITDA and all of these things. But for now, you can just think of them as both, because I'm really, you might not be excited about this, but I find this finally, because I've been trying for so many years to come up with a really good explanation of what's going on. And then this is the big deal. This is just our interpolated ROIC. And we have our interpolated ROIC, and we multiply that by the opening balance. Remember, I use the opening balance for everything. If you wanted in your models to use the average balance, you could certainly do that. Using the opening balance, remember, that allows you to do your NPVs at the end of the period, and get all the numbers correct. And then your cash flow is your NOPAT minus that additional investment you made in the opening balance. And then finally, you get we can finally start working on the terminal period. I think I'm going to put a little space here. The terminal period, we just use our same multiplier. And remember, this was always, in all these cases, this ROIC or ROIC or return on capital, whatever did I call it here? I called it ROIC. I shouldn't have really, I suppose. I should have just called it return because we're really looking at a return on equity. Uh, uh, that that's at the end of the period. And again, I'm sorry I'm going back, but this is so important to emphasize. This method uses this return, not that return. It uses the very last one. And even though it uses the last one, it comes up with a really high, much higher number because this is this whole business of this person who sat there and explained to me, oh, this is the perfect method because McKinsey is this perfect company and they figured it all out and it has some theoretical gradual thing. And that's why I said, no, that's a kind of crap. We have to go to 100 years to get there. That's for me such a big deal is that we can find the implicit true value that gets to this number. Okay, I'm not going to put it in, although that was for me such an exciting part of this video. I hope you think that that was an exciting part. Oh my God, we're at 37 years and we're not even close. I'm doing it again, and the graph's moving and all that. I'm at 45 years and I'm not even close. I don't know if I have to I don't know if I did this one the same 99 years, okay? And you could do that for all of them. And I don't know why I redid this. I hope I didn't irritate you by doing that, okay? And I'll put a 5-year fade period. I hope I didn't mess everything up. That's a dangerous kind of thing to do. Okay, and then finally we get the total cash flow, which is the cash flow. What's happening here? It's the Oh, this is the terminal period cash flow, excuse me. It is the ending, the beginning ROIC times our value driver formula times the 1 plus G. Now, don't forget that little 1 plus G that happened in all of these things. And then we multiply that terminal period. No, this is the terminal period. And then we add to that the cash flow that occurred over the fade period. Value at the final terminal period. I'm going to put value at the end of fade period. Okay, and then we add back our original explicit value, and then we get the final result. And you remember, and this is what I kept to really establish this all stuff, if you go to these simpler cases, this one gives the same answer. So that kind of proves that it all works, and it gives the same answer in these ones, and it even gives the same answer when we put a lower terminal return in. Oops. No, actually, it didn't give me exactly the same answer, but that's okay. It gave me the same answer as this one, which is correct. The reason this didn't happen is I still have this little adjustment in that last fade, that last stable period. Okay, but I'm leaving that one. I'm leaving that one. I think I've done enough, and I think this video is certainly long enough. And again, I'm going to do one more with the free cash flow instead of equity cash flow, and ROIC instead of ROE, and CapEx versus depreciation and working capital instead of dividends, and we'll get the same sort of results, except over here it'll say enterprise value to invested capital and EV to EBITDA, and we can even put EV to no pet, because that's really like the PE ratio. So that's enough. Okay, and this is enough now. And remember, I made this video so I can try to explain things in a course, and I would love your questions. That would be so wonderful to have a nice little discussion about this, especially since I'm sitting alone here all the time. Okay, bye.